Today's episode of This Week in Startups is brought to you by Audible.com, a leading provider of spoken audio information and entertainment. Listen to audiobooks whenever and wherever you want. Visit audible.com/twist for your free audiobook. And by SnapTerms, online legal protection made simple. Visit snapterms.com and enter the code TWIST to receive 10% off. And by Amazon Web Services. Get the resources you need to easily get started with AWS Activate, a new global program for startups, including AWS credits, training, developer support, a startup community forum, and special offers from third parties. Learn more and sign up at aws.amazon.com/activate.
Hey everybody, it's Jason Calacanis, and this is This Week in Startups, the show where we learn how to build companies, and boy, do we have a doozy for you today. This is my exclusive interview with Naval from AngelList, and we sat down at the LAUNCH Hackathon, and we had an incredible conversation about what matters in terms of building companies, raising money for those companies from angel investors, and the future of angel investing now that we have these crowdfunding syndicates. It's an incredible episode. It is required listening for any entrepreneur in 2013 and 2014. Get in there and listen to this amazing episode.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
Hey, what a great, amazing episode this was with Naval, and stay tuned for our friend James Altucher on the Audible Author series coming right up. So please join me in welcoming Naval Ravikant. All right, welcome Naval.
Thanks for having me.
I appreciate you giving up your Sunday to come talk to all of us.
I think these people are doing the real work. I'm just sitting here and talking.
They are.
Wish I could still code.
You started as an entrepreneur. You can pull up slide number 1 here. And you had 2 companies, I think, of note. Tell us about them.
Opinions was a company that started in the first bubble, the .com boom, and it was a product review engine. It went public as part of shopping.com. And then Vast.com is a white label sort of classified big data analytics company, still private, doing pretty well.
Now, those companies, what was your role at them? Founder, developer?
Yeah, founder and CEO.
Founder and CEO.
Yeah.
And when you look at that first wave and that crazy bubble we lived through, compare it to what some people are calling bubble 2.0, or at least frothy. And then tell us where you stand.
Yeah, it's frothy for sure in that it's completely different. First bubble, or first wave, you could say, there were tons and tons of money being poured into silly projects. So you'd get literally $100 million behind something that just made no sense and had no chance of ever making that kind of money back. Things are very, very different now. The markets are much larger. Everyone's on the internet. Everyone's got it in their pocket. We have broadband. We have 4G. People are much more comfortable using things, paying for things. There's API stack structure. So it's the scale of the opportunity is probably 100x what it was back then. And it's much, much cheaper to build a company. Opinions, we spent $5 million just building a first version of our website because there was no open source software we could use. We could use Solaris servers and Sun and pay Sun licenses and Oracle databases and host our own data center because the data centers weren't established, and T1 lines, and there was no CSS. We had to write everything in tables from scratch, no deploy scripts. So you just had to build everything from scratch. And what used to cost $5 million to do eventually cost $500,000 to do, and now costs $50,000 to do. So now we're in a completely different phase. We're in a Cambrian explosion sort of scenario where there's tons and tons of small startups and more being started every day. They're very cheap and easy to start. That said, these are still winner-take-all markets with huge network effects. So you get these incredibly outsized 1 out of 100 companies winning, and they win huge. So the nature of the market has fundamentally changed. The distribution curve is very different. I do think it's actually a much saner time to be investing as long as you're valuation sensitive and you understand the portfolio dynamics of how few companies actually succeed. And all your returns are going to come from being in 1 or 2 of those winners.
A lot of talk of a Series A crunch and it being very hard for people to get that Series A. Is it true or not?
It is true. That's because the number of companies exploded, probably gone up by a factor of 100 at this point, or rounds to that. The number of venture capitalists has not increased. So what venture capital now does is basically growth capital. Series A is really done by the accelerators and the hackathons. Series B is done by the angels, super angels, seed funds. Series C and up is where the VCs start. So I think I believe there's a fundamental misunderstanding still working its way through the system about how to build a company, which is people think the right way to do it is to kind of raise $1 million, $1.5 million from angels, then prove something out, then go to VCs and try and raise a Series A, which was a classic model, and that fails. And really the right answer is $50,000, build your product, launch it, accelerator style. $500,000, prove something big, and then maybe your next round is $1 million, $1.5 million, and get to profitability. Because it doesn't take that much to build a company anymore. Those of you who are trying to hire like 30, 40 people into your company, you're setting yourself up for a very, very tight funnel that you just squeeze through on the growth capital side with the VCs.
And why is this I would call it go small or go lean strategy, in your opinion, being probably the most knowledgeable person of the angel space, why in your opinion is this the best reason?
Small teams are innovative. They move faster. They get more stuff done. Most of AngelList was built by 6 people. Even today, after ramping up quite extensively last year, we're still only at 15 people. It doesn't take a whole lot of people. Look at Instagram, 4 people, Snapchat, 20 people. To the extent that you're hiring a lot of people, especially in software, that's mostly your ego talking. Unless you've got a $1 billion opportunity, tiger by the tail, and you're clearly winning, and people are throwing money at you, do not scale up. Premature scaling is the death of startups.
Great, okay.
And keep in mind, it's in everyone who's writing checks incentive to tell you to scale prematurely.
Why is that? Why do they want you?
Because they're going to bail you out. They're the ones who are going to show up and then negotiate the terms to bail you out. So it keeps them relevant and powerful. The part of the reason why AngelList exists and angels exist is because the cost of building a company has come down so much that the number of people who qualify as investors has suddenly exploded. They couldn't make a difference before. A $25,000 check would make no difference to you in 1999.
Yeah, but a $25,000 check can build a proof of concept.
Today,
correct.
Right. But not true earlier.
And so the VCs, or some of the bigger investors, they suddenly realize they might miss the chance to own 30% of your company.
Well, they do it now, but they do it through growth capital, right? They wait until you're big and growing, then they come in and they bid. So the venture capital game at this point has become about branding yourself to get into deals that are obviously hot deals.
Let's talk a little bit about AngelList in the early days. Maybe we can pull up slide number 2 for a quick second here. You started doing VentureHacks, and you and Nivi started writing these great blog posts unpacking the venture capital industry back in 2007. People were not happy about you doing this, were they?
There was mixed results, but at the end of the day, information and knowledge wants to be free. And so we just, Nivi and I used to sit around and talk a lot about how opaque term sheets were, and how as a founder, this is basically pre-accelerator, pre-blogging. So you'd go in and you'd get a term sheet from a venture capitalist, and you would have no idea what it means. And you'd basically sign it, and the Series A was the most important. You'd basically sign your life away, and then you'd find out 5 years later what it meant. And there was a game theory to this whole thing, to all these different terms and how they play out, and veto rights and all that stuff. And even your lawyer, although your lawyer you could trust, it's your lawyer, nevertheless, they spent more time serving the VCs and working with an ecosystem. You were the single move player in the game. The VCs are the multi-move player in the game theory sense. So they were always going to get the benefit of the doubt. So they created all these things that were standard, and then your lawyer would say, oh yeah, that's standard, that's standard, that's standard, that's standard. And pretty soon you find out that valuation is temporary, but control is forever. You've given up control of your company, and it's no longer your company. You're the entrepreneur, but you're working for somebody else. And I think that's a horrific situation that still many, many entrepreneurs end up with. I just had another coffee meeting Friday, with an entrepreneur who was doing great. His company was flying high. VCs took over, merging with another company, kicking him out. So it still happens. You got to be very careful. So we wrote it all down in VentureHacks, but people said, stop telling me how to negotiate a term sheet. Get me a term sheet. And so that's where AngelList started.
Okay, so next slide, and as you can see here, the most recent version, I think, of AngelList, or one of the recent versions, it started just as you emailing people opportunities that you met when you were out having coffee with people. Is that correct?
That's right. Yeah, I was having all the, I had a small investment fund. I was investing in startups, and I remember I had coffee with one investor, and he said, oh, I got this great hot deal, and we should move on it before anyone else finds out about it. And I was like, really? 2007? It still works like that? Like you can use proprietary information to sort of get some kind of advantage? It doesn't make sense. And sorry, this was 2010. And so I talked to Nivi, and I said, look, I know a bunch of investors. I do deals. So let me just take my deal flow and start sharing it. So we took 25 investors and we started sending out just emails, and then we switched to MailChimp, then we added Wufoo, and then 9 months later we started coding.
The site's gotten quite big now. How much has been raised through the site as a result of the site?
Yeah, it's about a couple of $100 million directly through the site, as a result of introductions from the site. Depends how you count them. Like, for example, we introduced Shervin to Uber. Right. He put in $100K in the seed, and then he did the Series C later. Right. Do we count that or not? We don't. So if we just count direct investment through introductions, it's about $250 million, about $10 million a month. And then on top of it, we also move about $4 million a month, $5 million a month, just purely online through what we call through syndicates, essentially, where people commit to small dollar checks online.
You yourself have invested in a lot of companies. Maybe we can go just to slide number 5.
Yeah, it's probably far too many.
Well, yeah, it's impossible to read, but
yeah.
How many companies have you invested in, and what's your current pace of investing?
I probably do 1 a month, small, 1 a quarter, big. Very opportunistic. You know, I'm in this business because I love technology and I love entrepreneurship. So even though I keep telling myself, no, I'm done investing, like I've got enough investments, I always see something new and shiny come along, and I'm like, oh, that's a great idea. Those good people, they know what they're doing, and I just get caught up in it. So it's hard not to.
Okay, so let's talk about something big, which is the Jobs Act.
Yeah.
Explain to folks who don't know what that is, what exactly happened that is relevant for founders.
Yeah, it's sort of the only major bipartisan bill to pass Congress and get signed into law in the last 4 years, which both sides sort of supported. And it does a whole bunch of nice things for startups. There's stuff that allows companies to go public more easily. The shareholder rule, the 500 shareholder max is raised, so you can have 2,000 shareholders. But the two most interesting things for most of you sitting in the audience is, one is the general solicitation ban is lifted, which means you can fundraise in public. It used to be illegal to go out there, for example, even at this conference, stand up here and say, I'm fundraising. That used to be against the law. Supposedly, you were only allowed to market to accredited investors, which is basically proven rich people that you had a pre-existing relationship with. Now that's changed. You can market to anyone. The downside is you have to do a lot more work after the fact to prove that they are rich and sophisticated and can take the risk. And that can be pretty onerous. You got to check their income tax forms, talk to their lawyers, credit reports, those kinds of things. So we're automating that and building that in AngelList, and going to provide that as a free service to everybody. So it'll be accredited once and then kind of reuse it wherever you go. The other piece that's relevant is true crowdfunding, where non-rich people can invest small, limited amounts in your startup. That's coming down the pike. It's still not legal yet. In all of these cases, the SEC drafts additional regulations to kind of mandate how it works. And SEC being SEC, they're going to automatically lean a little bit more towards what Wall Street wants, or how hedge funds work. So we always have to kind of write to them and get the community together and say, hey, look, this is how startups do it, and so this is how it needs to be startup friendly.
And you decided and I guess it was September, to launch public-facing syndicates, and I was one of the first to sign up for it.
Yeah, so if there's 100 times as many startups, we need 100 times as many investors, right? That just seems logical. You're not going to have billion-dollar funds allocating capital into all these little startups here, $50,000 at a time. And so these micro VCs must exist, and they need a platform. And so we created a platform for micro venture. So what Syndicate is, it allows any angel who's putting their own money, skin in the game, which is keeps you ethical and moral, to also raise money on the fly in the cloud from people who want to back them, like Kickstarter, but for equity. And you can build up a permanent backer base who gets first look at your deals in exchange for having first dibs on them. And we tried to make it very simple and move it all online. So what we have is we now have close to 100 angels who across them have close to $100 million in annualized backing. So every time they write a check, their money gets multiplied 5x, 10x, 20x, comes in on the same terms, gives them a piece of the profits. We form a single-purpose LLC in the sky that aggregates the money and puts one signature under the cap table, which that angel controls. The backers are basically backing people who are putting their own money at risk, only paying a piece of the profits. There are no fees. They can start or stop backing any time with one click. They own interest in an LLC, which could itself be secondarily traded, and they get a beautiful in-the-sky dashboard brokerage-style view of all their holdings. For the lead, they basically have a liquid back end to LPs now. And they don't have to be a full-time venture capitalist. They can continue doing their job as an entrepreneur or whatever they want. And once in a while, when they see a great investment from an entrepreneur they know and trust, they can scale up, do the series, this whole seed round of the Series A, and then move on.
Hey, what a great episode this is with Naval from AngelList explaining to all of us how to raise money and build our companies. But one critical piece you don't want to forget is having a great terms of service. And the best way to do that is to have the support of our friends at Snap Terms. That's right, snapterms.com is simple, affordable, and it's the fastest way to protect your website with a proper terms of service and a proper privacy policy. If you don't have these things, you are risking everything. Your angel investors' money, your startups, your whole team's experience. You have to have a great terms of service and a great privacy policy. And fear not, it's not going to cost you thousands of dollars. They start at only $299. Use the promo code TWiST and you'll get 10% off your order. The folks at Snap Terms really value the This Week in Startups audience. They tell me that every time I talk to them. And we use it here ourselves. Go to thisweekinstartups.com/legal to see our funny terms of service. Thanks again to Snap Terms for providing such a great service. As everybody knows, we have our choice of partners here at This Week in Startups. We're that lucky. And we use Snap Terms, so we're like, hey, if we love Snap Terms and we use it ourselves, why not? We're telling everybody about it anyway because we're saving them thousands of dollars. We might as well ask them if they want to be a partner on the program. And they've been a partner on the program for over 2 years. They're second only to probably MailChimp in terms of their support of the program. So I really do thank them. And you should too on your Twitter account. Go ahead and say thank you at Snap Terms and tell all your friends. Don't waste a ton of money on your terms of service. Go to the pros, and the pros are the folks at snapterms.com. Thanks again, Snap Terms.
Where do you think this is going in terms of your doing it right, doing it lean strategy, which you outlined earlier, which is to say, if somebody was going to do the $50,000, $500,000, $1.5 million deal, it seems to me that aligns with exactly what AngelList syndicates and AngelList sort of classic is capable of doing.
Yeah, I mean, essentially between incubators, AngelList and syndicates, super angels, seed funds, you should be able to get to escape velocity. And that's the point at which you go for venture. Essentially, especially on the consumer side, it's a little different in the enterprise and hardware, but especially on the consumer side, no Series A, quote unquote, VC wants to talk to you unless you have escape velocity, or unless you're an extremely branded entrepreneur. And even then, they want you to have a product and some indication that you're going to hit escape velocity.
Yeah, I kind of hit that road already now.
Yeah, I think even the super angels and the seed funds are starting to operate on that basis. The bar has gotten really, really high because there's so many startups.
So you have to show traction.
You have to show some traction, yeah. Or you got to show something, or you have to show you did something really unique and difficult, which is very hard to calibrate because everyone thinks you're doing something unique and difficult,
right.
But you need a third-party validation on that.
Well, something like Pinterest or Airbnb or even Dropbox might on its surface not look very difficult.
Correct.
Those things, if they existed today, what would they need in each of those examples, in your perception, to get an A round from a top-tier VC?
Oh, today they'd need 100,000 monthly users climbing fast kind of thing.
Okay.
At least.
So Dropbox would have to have 100,000 monthly users climbing at 20%?
At least 20. Yeah, 20 is probably the minimum.
Wow.
Yeah.
And they weren't doing that when they raised previously.
No, but the bar just moves up in the market constantly.
Wow.
Yeah, that's just the nature of the beast. I mean, I think Dropbox's first round was a pre-money of 3 million or 4 million, something like that. Right. So, and the valuations were lower back then. 2007, 8, 9, the valuations were probably 2, 3, 4 million. 2009, 10, 11, 12, they kind of went a little crazy, got up as high as 6, 8, 10. Now they're coming back into the 3, 4, 5 range, I'd say.
What do you think of the accelerators and their future in all of this? I mean, we have, obviously the YCombinator and TechStars, which are, the gold standard right there. And then a lot of people creating derivative, knockoff or, good intentioned, and sometimes well executed, sometimes not well executed. So what is your advice to folks should you give 6% of your company away for $15K and join Y Combinator? Is it worth it?
Yeah, accelerators are a very complicated topic. We're basically witnessing the unbundling of advice, control, and money. No one wants to give control, so that's where the angels come in. They come in with money. Syndicates brings backers and more money. The accelerators have sort of branded advice and institutionalized it. I think of them as kind of the new graduate schools, except instead of paying to go, you get paid to go. Instead of going out and getting a job, you get out and create jobs. Instead of doing derivative work, you do original work. So they're better graduate schools, and they're shorter and faster. So if you're just starting out, if you don't have the contacts, if you need some help in what you're building, if you need a network, and if that first 25, 50K really matters to you, then by all means do an accelerator. If you sort of have already built your product and starting to get a little bit of traction, you can get there on your own. If you're pretty savvy about how to build a company, and if you already have your network in place, then it's a pretty expensive deal. But obviously it depends on the accelerator. Yes, there are too many accelerators, but there are also too many VCs, there are too many companies, there are too many angels. There's always too many of everything in this business.
Yeah.
It's like the Kentucky Derby. Yeah, there's 16 horses running. There are 15 too many. But you don't know in advance which 15 are too many, right?
Exactly.
That's the whole point. So you have to let them all run. And on the accelerator side, you could have argued that TechStars was redundant, but they turned out to have some great classes. AngelPad was redundant, turned out to be a great set of ex-Googlers. Lemnos was redundant.
Which one is the
some
most
hardware
impressive
stuff, right?
to you in the last year? Pick the top.
The
pick your
most
top 3 most impressive accelerators that aren't Y Combinator in the last year, or TechStars.
Yeah, I don't want to so much pick favorites. I would say I was.
Who had the most impressive class?
Yeah. I was surprised by a couple of outliers that came in from left field. StartMate seems to creamskim Australia and bring in the best Australian companies.
Which one is that?
StartMate.
StartMate?
Yeah, they brought in some really good companies from Australia. They're a little off the radar. Mucker Lab has had some great companies out of LA. There's been Lemnos Labs has had some great hardware companies.
Where are they?
Lemnos is right here. They're in the city.
And they're specializing in hardware.
Yeah, they had Momentum Machines, which got funded by Khosla, and Airware, which got done by Andreessen and a few others. AngelPad obviously has just crushed it. Mopub exit, but there are lots. 500 Startups is killing it internationally. Maybe they have a great space in Mountain View, but in the U.S. they compete with YC and TechStars and all that. But you go international, they're the only game in town, and they have a great brand and great reputation.
If you had an idea today, which you could get your basic funding for. But it could go either enterprise or consumer. Let's say you had the idea for Twitter and Yammer, and you're sitting there with your team of 4. You got your funding equal for either idea, so you could get your 50 or 100K to start building. Which one should you build, and why in today's market?
Well, it depends. First, build the one that you're more passionate about, because you have to be the best in the world at what you do. Number one. There is no, it's the old Glenn Ross line. Number 1 gets a Cadillac Eldorado. Number 2 gets a set of steak knives, and number 3 gets fired. Right. So that's like the salesman hierarchy, and it's kind of the entrepreneurial hierarchy too. So you have to be number 1. And so in that sense, you have to be passionate because you're competing against the best in the world doing what they love to do. That said, most people are much more passionate about consumer stuff. So if you can get excited and be passionate about something on the enterprise side, and if you have some experience there, it would probably be foolish to wander away from that.
So what are the chances of success today for startups pursuing an enterprise strategy versus a consumer strategy, if you just had to say, out of 10, this many will have a pretty good outcome versus a not a good outcome?
Yeah, on consumer, it's some fraction of 1 out of 10.
Less than 1?
It's less than 1, yeah. And on enterprise, it's probably, it was like 1 out of 3, 1 out of 5. It's probably 1 out of 10 now because it's getting crowded. So just for this future class. But that said, entrepreneurial ventures fail all the time. Most of my companies failed. I actually started 7 companies, and I've launched about 40 or 50 projects over my career. And AngelList is the first one that I would truly say is product market entrepreneur fit for me and might succeed down the road. Right? So it's a low hit rate over your career, but you only have to be right once. It's like your relationships. You only get married to one person, right? Or it's like what you study in school. There's only one set of things you study that stuck with you that you made a career out of. So you only have to be right once or twice. And so you just keep trying, just keep iterating, flow with it, stay open. It helps if you have an arc or a theme through your life, like people like Evan Williams, I think, are always like hammering on the same problem.
Publishing.
Micro-publishing or easy publishing on the web. And so he just keeps hammering the same problem, so he just gets better and better and better at it. So it helps if you have sort of an arc or a bent to your life and you're not just hopping from sphere to sphere or project to project. But that said, just, a lot of it is market timing, and you learn a lot of lessons. You learn, first you learn how to, you do everything wrong. You make a whole set of mistakes probably your first startup. And the second one, maybe you do things right, but you do it with the wrong people. And the third one, you might do it with the right people in the right way, but at the wrong time, right? So you learn all these painful lessons. And some of it is just dumb luck.
How many years did it take you to get to AngelHack? How long have you been professional? AngelList, rather, to be been a professional.
I started early for my generation, but back then everyone used to start startups later. So my first startup I started when I was 23. I started AngelList when I was 36. I'm now 39. So, 13
years.
13 years just pounding at startups nonstop, right? Always like I would do my startup during the day. I would have my day job. I would run home at night. I'd brainstorm more startups. I was just in love with it.
When you we're going to get to audience questions in a minute. When you started AngelList, there was significant pushback from powerful people.
I don't think anybody who's doing well under the current structure likes change, but AngelList is a byproduct of the fact that startups have gotten so cheap to build, and so there's so many of them. And whether it was called AngelList or it was called something else, it would exist in some form or another. It's one of those things that there has to be a place in the ecosystem to organize all the companies and all the investors.
What was the thing you found out about later that you thought was like somebody tried to stop you the most? Because people have tried to stop this train. Like, what's some examples like of people who tried to? You don't have to say the names of the people, but how they tried to scuttle this project.
Sure. The number one way in which people try to scuttle is people who have a lot of money and are used to the old way of investing will tell entrepreneurs, well, don't go on AngelList, only the desperate companies go on there. And I think we're sort of...
The desperate people go on there.
Yeah, it was the same thing that got said about YCombinator in the early days. And I think at AngelList we work very hard to make sure there's no adverse selection. We don't take a cut from you for listing or for getting funded. We don't... all companies are on there. Now you have Yelp and BitTorrent and others recruiting on there. So there's no social stigma to being on there. That was something we fought with over the years.
So they tried to make the companies look... like they were the desperate ones. And I agree with that.
Yeah, I don't think it's any grand conspiracy. I think it's more just human nature. It's just like when you're telling your investors that, hey, I have unique access to deal flow. I'm this person that sees things that other people don't see. You have to be consistent with those statements that you're making all the time. And so you go to entrepreneurs and you basically keep under this illusion of proprietary deal flow. I think people have given that up now. Deal flow is public. It's access that's proprietary. And access that's proprietary is still based on kind of fuzzy brand. But I think what we are arguing is that first we're going to make that transparent. So what your value add is, let's see it, put your cards on the table and let the entrepreneurs know and give them choice. And the second is there are a whole bunch of people today who are highly value added, who have good access, but don't necessarily have the capital. And that's what Syndicate solves.
Right.
So we're sort of unbundling all the pieces and making them transparent. This idea that there are only certain people who can invest in seed and other people who can do growth is sort of a false dichotomy. If everyone can see everything, then you can cross boundaries all day long. You should have angels to be able to do... Did we lose?
You got it. You're back.
All right, we're back. You have angels who should be able to do a Series C or a Series D. There's no reason why someone like you or David Sachs at some point shouldn't be able to put $1 million into a company, have a $10 million syndicate behind you, and do a Series B. And at the same time, a venture capitalist should be able to say, hey, the accelerator deal, I want to set up an accelerator in the cloud, but I want to offer $100,000, $150,000 for the 6% instead of the $25,000, and here's my structured network. So the moment you take all the companies and all the investors and you throw them in one place together, people can start cross-pollinating.
Got it. When you started getting that resistance to AngelList, did that act as motivation and a signal that you were doing something right? Or did it make you feel like maybe I'm like becoming an outcast and I'm kind of like too much of a rabble-rouser?
Well, I've always been an outcast, so that's easy.
So it's kind of easy to accept?
Yeah, Red Herring did a hit job on me back in the day, which said something like, this guy will never work in this town again. And
well, that's what people said when you launched AngelList to me.
Yeah, and Red Herring is gone and I'm still here, so that worked out.
You've outlasted Red Herring.
Yeah, but I don't care about that. the reality is it just made sense. I mean, there's some things you just know with the core of your being that you're meant to do and that are right. And you don't care what other people think. It's like when when I married my wife, like all kinds of people started coming up and giving me opinions about, oh, she's really good for you, or I think this way. I'm like, I don't care. I don't need the opinion. I got it, right?
You should have heard what they were saying to your wife.
Yeah, exactly. Well, right. They tried to talk her out of it. But yeah, I would say that, if it's the right company, then that means you know your domain, you know you're meant to do it, and yes, other people's data matters. If they really mean well for you, and if they have data, keep an open mind. But if they're just giving you an opinion of whether it'll work or not, that's useless. They should go write a comment on TechCrunch.
Right. How bad is journalism today? When you, specifically, I'm not going to mention any publication's name, but just in general, being an insider who sees the actual real data, the real information, and you have journalists who are writing who've never run a company, never failed, never succeeded, never took a company public, never sold a company, never did layoffs, never done investments, basically opining on the industry. What percentage do they get right overall, this sort of tech press? On a percentage basis, 100 facts, how many do they get right?
Facts? I mean,
facts, opinion.
Yeah, they probably get most of the facts right, but they miss all the nuance. And the nuance matters a lot. The problem is that journalists are not domain experts, not really. And so they don't have much time. They're paid on page views or whatever, so they just dig in. They don't dig in. They don't have the time to dig in. So a lot of reporting is very superficial and incorrect. The interesting part is the people who know the most and who can do the best writing are bloggers like Semil Shah, for example. He's entrepreneur, now VC, understands the space, builds a brand by blogging. And you see this a lot. A lot of the great venture brands now get built by blogging because those people can really, really dig in and understand the nuance. The problem is that there's incentive bias. The moment you're a venture capitalist, then you're going to start talking about how it's really important that you take growth capital and you take money from the right people, aka me, and that you scale up fast, right? So you have to filter out all the bias in the system. And there's a lot of bias in the system. Everybody has something that they're trying to sell you. I mean, frankly, we're in business, right? This is all business. At the end of the day, you're here to build a product to make money. You're not here for just,
It's not charity.
Yeah, it's not charity, or you'd be in the art gallery, or you'd be in the studio or something. So because the business, everyone has bias, everyone has incentive bias, and you got to subtract their bias out whenever you listen to them. And what galls me is just the huge amount of blogging that goes on with no disclosure of the bias, or maybe it's like a little line at the bottom, but the whole thing just drips of bias.
Right.
But I think fundamentally people get past that. People they don't necessarily always like the sound of truth because it's harsh, but I think people like the feel of truth. They know what truth feels like. So I think it's very important whenever you're communicating with other people in this industry to try and drop your bias. But it's very hard to do. Very few people do. I think that's one of the reasons why Fred Wilson's AVC blog is so popular. Whenever I read it, there's just a certain honesty that comes off the page. Right. James Altucher, that guy bleeds on every page. He's so painfully honest. You can't not believe him.
It's train wreck and awesome and great at the
same
time.
But it's such honesty, such truth. I wish there were more journalists and bloggers like that who spent the time, did the homework, and tried to remove their bias from their reporting.
What makes a company, because I'm going to start putting companies obviously to back, I'm hoping to put the top 2 or 3 companies here and put them out to Syndicate if we can make them, real companies.
Yeah.
What makes a company, and this will be my final question before the audience goes, what makes a company, in your mind, worthy of me or Kevin or Dave putting it out to our syndicate? What do you want us to filter for?
Yeah, so, what makes a great company is actually different than what makes a great syndicate. And obviously we want to try and converge the two, but one of them is reality, the other one is perception of reality. Reality, what makes a great company, this, are great founders who can build a great product that are going after an open market. Right? And that is your judgment call. That's why syndicates exist. That's why we don't believe in this concept that you can just have a giant list of companies in the cloud and you can somehow pick the winners from the losers without ever meeting them. Someone has to go in there with judgment and access and do the homework and spend time with the company and figure out if the founders know what they're doing.
Great founders, great execution, great market.
Right. Now that's what makes a great company. Now what makes a great syndicate is you have to convey that to people somehow. So the way you convey that is what we just use the catch-all term signal. It has to be a high signal deal. So are the founders accomplish? Have they done something in the past that would indicate they're capable of things in the future? Is a syndicate lead a good judge? Do they have a good track record? Do they have any early traction? Do they have any indication that the dogs are eating the dog food, so to speak? Is the product visually appealing? Or is the space not too crowded? Is it novel? Is it new? That matters too, because on AngelList, people see everything. By the time you see the third or fourth of something, it almost doesn't matter how well executed it is. People have sort of already made up their mind in the space and probably invested in something. So that's what we call signal. And then the backers in the syndicate case, right now, today, most of them are actually pretty high-value angels. So like, for example, just this morning, I'm looking at my dashboard, and one of the syndicate deals that's out there right now, Jeremy Stoppelman and Charlie Cheever just committed, one of the founders of Quora and the CEO of Yelp, right? Those people really shouldn't be backers. I mean, they are backing because they don't necessarily want to do coffee meetings, but they're interested in this company, they believe in the lead, but they don't necessarily want to spend a lot of time in the company, they just want an economic stake. But the real backers are going to be limited partners, funds, people who are out of market, wealthy individuals who are not professional investors. So those people, you need to also send them a high signal, but also show them there's not a lot of access in this deal. Because otherwise someone's going to say, well, why am I paying you the carry, Jason? Why am I following behind you? Why didn't I just go direct into the deal? So we call it high signal, low access. That's kind of our balance.
I was thinking if I did a video with the founders talking about the plan and maybe showing it and me sort of peppering them with questions and do you think that would add value to the people? Would they want to, the backers want to see me interviewing them? Would that give me an advantage as a backer?
It might. My experience so far is that most investors don't watch videos, just statistically speaking. That said, we have Q&A functionality in the profiles now, so you could ask questions and they give the answer. So I think you can get the same effect, but in a more easily digestible format.
Got it.
You could add a video too. I don't think it hurts. I just think on an ROI basis, you probably.
What if I wrote a blog post about why I'm jazzed up about the company and the team? Would that be?
That would be helpful.
That would be helpful. Okay.
But I think one of the very important things here is that the backers really need to understand. You need to convey to them things like, what deals am I showing you? So that they know that there's no adverse selection. You're not just keeping the best deals for yourself and then sending them the extras. They have to also understand that this is extremely high-risk investing and that they should spread their bets over a long period of time and be very careful and go slowly. I mean, it's not gambling, because gambling is a negative expected value and the house is working against you actively.
Right.
So hopefully this is a positive expected value and it's good for society, but the distribution curve of outcomes looks a lot like gambling.
Got it.
So people have to understand that and be comfortable with the risk and the fact there's no liquidity.
What should an investor do in terms of number of deals? 10 deals, 30 deals, 50 deals? If they were going to optimize for a number, if it was your cousin, and they said, I have $100,000, should I do $1,000 into 100 if I'm able to do that through Angels, or should I do 2,000 into 50?
Yeah, I don't think there's a single right strategy there. It depends obviously on the conviction that you have around a given company. But just realize you can have enormous conviction around a given company and still you're usually going to be wrong. That's just the nature of the business. So I would think that to get a decent portfolio in the angel space, you probably need to be at least 25, 30 companies would be my guess. And you could certainly take the point of view that you should do a lot more. And there are practitioners who do less. They'll do 10. But for those people, they are diligencing the heck out of those companies. They're putting a lot of wood behind that arrow. They're spending a lot of time with the companies. These are classic early stage venture capital type approaches. And unless you're willing to put in that time and diligence, you cannot narrow your portfolio down that much. The one thing you could say is maybe a little unfair, but diversification is a hedge against a lack of knowledge. But here, no matter how much work you do, you're probably still not going to have more than 30% knowledge. 70% is still up to the market and out in the air, and so many things can go wrong.
Pivots yet to come. Okay, let's take 3 questions or 4 questions from the audience, and then we'll all get back to work. If you have a question, just raise your hand, and I want to make sure people in the back of the room also. So, Scott, you're our runner. After you get this first person, I want you to run all the way to the back and get the next person. I'm joking. You can do 2 in the front, 2 in the back.
Hi. What's your position on Bitcoin? I know you're bullish, but does AngelList plan on using Bitcoin for something?
I'm personally a fan of the Bitcoin protocol. I think it's very innovative and world-changing. Anyone who's interested in HTTP, for example, should understand Bitcoin, because I think it's a next-generation kind of protocol for distributed contracts. I have a little blog post on it that I just put up recently. As far as Angels itself accepting Bitcoin, I mean, that's kind of just a gimmick at this point. Like, no one really uses it as a currency at scale. So those days have not yet arrived and may never. And so AngelList already operates in a highly regulated space with all kinds of minefields. I don't need to introduce Bitcoin in there to make my life a headache. That said, the moment it makes sense, you bet we'll support it. I mean, it's a great thing.
Do you think there's a chance that Bitcoin could become a total... What are the chances Bitcoin becomes a total wipeout? Like somebody hacks the system or something bad happens where people just loses complete trust or government intervention or something.
Extremely high. I think right now the value of Bitcoin is based on like a 1% chance of like a huge positive outcome, or like a single-digit percentage chance of a huge positive outcome. That's why it fluctuates so much, because when those odds change from like 2.5% to 3%, the valuation goes up drastically or down. So that's why it's so volatile. If there were 100 lottery tickets to buy like Bitcoin, I'd buy them all and diversify. Unfortunately, there's only one. So most people who say Bitcoin is going to fail are probably right in like the absolute sense, like you may lose an investment, but are they right in the sense that cryptocurrency is going to go away, or the proof of work function, or the distributed ledger is not going to make a huge impact on computing? They're wrong about that. So it is a fundamental technology to know.
The distributed ledger, explain that in plain English to somebody and why that's important.
Yeah, so basically, when you exchange money with other people electronically, you always go through a central authority. And you need that central authority to keep track of who sent who money, and so who's got it, and to prevent double spending. In other words, like I write you a check, I write somebody else a check. The way we know the check bounces is because the central authority, the banks reconcile it and knows that, no, you can't send that same money to two people at the same time. So Bitcoin has to solve that problem in a decentralized way. And it does that through a proof of work function, which is way beyond the scope of this discussion.
Yeah.
But just go to my blog, look it up. And then through a distributed ledger to keep track of the transactions. Distributed ledger means that the record of all the transaction is stored in every wallet. So every user at all times has a record of every transaction ever done in the history of Bitcoin.
It's going to get pretty big at some point.
It is. And there are ways to prune it and to put part of it in the cloud and then to securely look up and make sure that you're only growing on the right part of the part that you authenticate in the cloud. So it's solvable, but the basic idea is that you should not have to rely on anybody else to authenticate that a transaction happened. You can look inside your own wallet and say, oh yeah, that transaction happened in an absolutely verifiable, irreversible way.
Next question.
Hi. First, I just wanted to say thank you guys for creating a platform and a space for us to be creative and just do some great things. So. But secondly, I just wanted to ask, especially with AngelList, you and the syndication model that you're using, you've really kind of gone out of the box about how to come up with different ways of solving problems. And I just wanted to know, because you were talking earlier about the issue with Series A funding, is there anything that you are aware of with regard to like flexible purpose corporations in California and the models that those might make for different types of investing in the future?
Yeah.
And as well as your social startups as well.
Yeah, there are definitely investors who focus on social startups and dual purpose startups and startups with meaning, but it's not a lot of investors. And they're certainly not on the venture side. They tend to be much more on the angel side. So I know, for example, Tony Shid Zappos and Tabriz Verji and Mitch Kapoor and Johnny Nguyen and people like these really want to look at startups that have a social mission with them. But they're not getting the huge amounts of LP dollars. These tend to be people investing their own money or very small amounts of purpose-driven money. There is more of it coming. But it's still difficult. I would say you absolutely have to make it viable in every respect as a for-profit business. And then if you happen to get one of these socially interested investors, consider that gravy, but don't count on it. Don't think it's going to give you any advantage.
It might actually give you a disadvantage, wouldn't it?
I think it does give you some slight perceived disadvantage with most investors. Yeah,
I mean, when a pitch starts out with, we're going to give this amount of our profits to charity, the first thing I think is, well, what is the business that's going to enable you to do that? Or why not just make a really great business and go be Bill Gates and give all your money away after you build a great business?
I mean, that's one good point of view. I mean, some of it is you have to believe that every company that we're building here, these are not hurting people, right? Hopefully we're not launching drone attacks or whatever, torturing people. So we are helping the system, right? We're moving human advancement forward. Creating jobs, creating great products. Look at how the iPhone has just improved the lives of people all around the planet. I would argue Steve Jobs was the greatest humanitarian of the last century, in that he empowered more human beings with a computer in their pocket than probably anybody else. Is AngelList socially conscious? I like to think what we're doing is ethical and helpful, and stands up for the underdog and the little person. But we can't help everyone. We fail all day long, and I don't pitch that mission. I just pitch it as we're building a great company and a business that we're passionate about. That allows us to recruit people and raise money and stay focused and motivated. But of course, we're going to do it in an ethical, socially helpful kind of way.
Okay, next question.
Hi, I'm James Jones from Telex Networks. Just curious on, how long does it normally take to get some good traction on AngelList, to get recognized, to get shown? Because our stuff's been on there for a while now, but it just seems like maybe we're not messaging it right or whatever.
No, I mean, look, very few companies get funded as a percentage of the ones that are in the entire ecosystem, whether it's here, whether it's at AngelList, whether it's wherever. And so it's not a question of messaging necessarily. Basically, right now, companies get funded in one of two ways. One is, actually three ways. One is they have an investor offline who has a presence online, and they bring the company in, either as a syndicate lead or send it to their followers and gets funded on that basis. Second is it can just get discovered, which is there are investors who say, well, I want to invest in a parking meter company, smart parking meter company. So they go look at everything in the space on AngelList, and they reach out to all of them, and then they find one. And then the third is we feature it. And we review for featuring every week. We review hundreds of companies, and we look for which ones have traction and are novel and interesting. And anytime a profile updates, we go back to re-reviewing it. And unfortunately, there really is no self-service reach out to investors for everybody, because that turns into a giant spam fest. And so you just have to basically keep updating your profile, using it as a calling card with investors. Perhaps it'll get picked up, and they do all day long. I mean, 5-10 companies a week get funded, but hundreds apply every week, or not even apply, but list. So I think you have to treat it a little bit more like a LinkedIn. It's not necessarily going to be the only way you find a job, but it helps to have a resume on LinkedIn if you want to get a job.
What are some of the, hacks, if you will, things that work really well? So I have a lot of people say like, oh, I'll just give you free shares of my company to, let me put you down as advisor. I don't obviously take it, but
yeah, that doesn't do that much. I mean, those hacks don't work. We close those hacks whenever possible.
Yeah.
Really, the hack that works the best is having a great company, having a really kick-ass, up-to-date profile, and keeping it up to date. And every time you get an investor, for example, added to your round, you add them, and we notify all that investor's followers that, Jason's now investing in the round, and people pile in. So people get the signals and the notice, and we'll notice, they've put up 3 months of 30% growth. We should feature this company, right? So the data flows through. The signals are there. Data's all structured. And so it's easy to track, and there are lots of investors now using our API. We do probably 5 times the volume through our API that we do through the site browsing itself.
So somebody could hit the API and say, show me the companies that have reported this amount of growth?
Correct.
Fascinating.
Yeah.
And so you're a big fan of this rolling close on the convertible notes, because it allows you to put, Dave Morin invested this week, and Jason Calacanis this week, and whoever, Jeremy next week.
I mean, I wouldn't say I'm necessarily a fan. I just think that it has certain advantages, and one of those that you can keep fundraising all the time. The idea that you fundraise once, then it's closed off for 18 months, then suddenly somehow magically reopens and closes again. That is an artificial old model driven by the realities of how venture capital and fundraising used to work. The reality today is now more of a blend. You can probably do your fundraising over 6 months where you can keep a convertible note open. After that, to keep it open, you probably have to show some real traction, because the signal from the original investment will now sort of be dying down.
Got it. One more question. Final question? There's 2 up here. Here comes Scott. Look at him. He's running. Get in there real quick. Thanks, Scott.
Hi. Given what you know about the space, do you think it's possible for a startup that does crowdsource knowledge similar to Wikipedia to succeed? And what would it take?
That's a highly specific question. Could I start? Yeah, everything that's great on the internet is crowdsourced to some level or another. It's very rare to find a business that isn't some variation on crowdsourcing. Uber is, crowdsourcing the back end, limos and assembling them together. Google is crowdsourcing the intelligence that's in the backlink. So even the companies that don't look like they're crowdsourced are fundamentally crowdsourced. And what the internet companies generally do that works really well is they aggregate huge amounts of disparate knowledge in individuals and pull them together. So in that sense, theoretically, yes, but the devil is so much in the details.
One thing I would add to that is just people often look at the Wikipedia as like a roadmap, and I think it's kind of a black swan. It's like it needed to exist in the world, it exists, and now it no longer needs to be done, right? So this idea that you're going to make a better Wikipedia or that is some sort of a roadmap.
I mean, you'd have to do
I'd
it
be careful with that because I've seen a lot of pitches.
You'd have to do it in some fundamentally orthogonal way. Either something will have to have changed, like for example, mobile came along and Wikipedia didn't keep up, which is not true, but something would have to have fundamentally changed. Or you'd have to have a fundamentally different take on the problem. For example, Quora, you could argue, is trying to augment or not replace, but stand alongside Wikipedia as an equally powerful and important entity. But they're basically saying is, oh, we're going to crowdsource knowledge for things where it's specific knowledge and you need the answers from multiple individuals, and there's no single canonical factual answer. So Quora works much, much better for those kinds of things. So I think you may have to look for an adjacent domain of knowledge that Wikipedia cannot address or doesn't choose.
There's also a little bit of, just one final thing I'll add to this, a little bit of fatigue in the crowd. So a lot of people think like you started and then just a lot of people are going to show up. And what I saw over the last decade of people doing crowdfunding stuff is you build it and nobody shows up or few people show up. So you have to really have a long-term, slow, build a fire from tinder and, twigs and then build it up to a fire. Hey, listen, this has been a fascinating discussion. Naval, as always, you've been very insightful and honest, which always makes you a great fireside chat. Let's give it up for Naval.
Thank you, everyone.
Awesome.
Hey, everybody. What a great interview we had with my good friend Naval from AngelList. And boy, do I have another treat coming up for you. My good friend and good friend of the show, James Altucher, is with me. He's got a new book out called Choose Yourself, and it's available at Audible. And Audible is doing an Author Extra, which is basically at the end of the program, instead of reading you an Audible ad, I just figured, I got a lot of juice, and I got producer Gina, and she can make a couple of phone calls, and we'll just get the goddamn author on the program and talk to them directly. Why do a commercial when we're all interested in these books that are on Audible? We'll just talk and we'll learn. And so, hey, James, are you there?
Yes, right here. Excited to be on this show, and I'm excited to talk about Audible. Actually,
you're a fan of Audible, of course.
Yes. I read. Let me give advice to authors just in general about Audible. Read your book out loud, and then rewrite the entire book. Because when you're reading your book out loud, and I did this you have to do that to make an Audible, you learn which parts of your book are boring because you don't even feel like reading them. So it makes you. I rewrote my entire book after I read the book for Audible.
So you've now got a new technique. If you've written a book, read it to yourself out loud as if you were going to record it into Audible, and then realize how boring you can be at some times, and then edit those parts to not be boring. Is that correct?
One step further. Don't just read it out loud to yourself. Read it for Audible. So I made the audio recording of my book. I did not read. I did an unabridged version. So I just read what I thought was interesting and left out all the boring parts. And then I completely rewrote my book from scratch.
Wow. See, that's interesting.
Yeah.
So now, tell us, what is the book you have here? Now, what you chose to write a book, and it's called Choose Yourself. And you got Dick Costello to write a foreword. That's kind of a big deal. What is the purpose of this book?
So the purpose of the book is basically a couple purposes. One is to show how the economy itself is changing right now to completely eliminate all of the middlemen and all of the gatekeepers in the world. So you essentially, in order to succeed, and even in order to find some degree of happiness, you have to develop your own mastery. There is no longer any safety given by school or by your job or by any of the institutions that we've been taught to believe are safe. You have to find your own mastery. You have to choose yourself to succeed. And so in my book, I show that. But the other purpose is to show that choosing yourself is not the traditional work hard and succeed. Often you have to go through what I have gone through, which is fail miserably many, many times, pull yourself off the floor when you're practically suicidal. In fact, I was suicidal, and succeed from that point, because it all happens to us. We all get to this point where, oh my God, how could it have been possibly that bad, what just happened to me? We all have to pull ourselves up off the floor, and if we're going to succeed from there, it's really difficult, and I sort of show how I did it. I don't necessarily say my technique works for everyone, but I show how it worked for me.
Well, take me to that worst moment in your entrepreneurial career? Because I do know we've known each other for a long time, right? And
Sure.
I know that you've had some great successes, but you've also gotten your ass kicked brutally a couple of times. Take me to the most brutal moment of your career, the moment where, you just felt like paralyzed. I can't get out of bed, and this is the end for me.
I think that's happened to me more than once. It's happened to me at least 3 times. And it's almost like statistically significant. I had to look back and say what worked on the way up and then what worked on the way down. But I'll give you an example. The very first time I sold a business, which you're familiar with, Reset, I basically was like a drunken rock star. I made all this money and then I spent it. I bought houses, I gambled, I lost it in the stock market, I did everything. And then I literally was thinking to myself, I had just won the lottery because the internet boom had busted, and now I lost probably about $1 million a week in one particular summer, and then I was broke. I didn't have any money at all. I lost my house, I lost my family, I lost my friends, I lost everything, and I had to pick myself up off the floor and figure out how to succeed again. And I had to do that twice more. So finally, it occurred to me, there's one thing that I'm doing when I'm on the way up, and I'm just going to stick to it. And it's a daily practice. I have to every day stick to it. And that's simply be healthy. But I don't mean drink your vegetables. I mean be physically, emotionally, mentally, and even spiritually healthy. Like I always have to be grateful for what I have instead of squander it. I have to come up with new ideas every day. I can never view myself as finished. I made this money, so now I'm done as a human being. It's all over. I have to be emotionally healthy. I have to be around people who I love and who love me, or else I'm just back in the mess of negativity. And I have to be physically healthy. I have to sleep, eat well, exercise. All of these things together work towards making me specifically a success at what I do. It might not work for anybody else, but it worked for me.
Well, so how much then of being successful as an entrepreneur do you think is this sort of just being a good human and being, fit and alert versus actually the hard work you do putting into your company? Is it 50-50?
Well, they're all together. It's not separate. You can't put the hard work into your company unless you have energy, and you get energy by being around positive people, by being grateful for what you have instead of taking your energy and pouring it into regrets of the past or anxiety of the future. You have to worry will always sap your energy today. It will never solve your problems in the future. So you have to work on ways to eliminate worry and stress. And the way you do that is by being healthy in these 4 areas of your life: physical, emotional, mental, and spiritual. Else you will not have the energy for your business. Or at least, again, I say this for me, but I also now I have enough experience with readers to know that this has worked for thousands of other readers that I have. Because I talk about this.
Yeah. Mm-hmm. Take us through some practical, when people say, hey, I have to be emotionally and spiritually, level and complete and healthy. What does that actually mean? Like, what's a way to be more emotionally and spiritually, stable? Give us some techniques here.
Very practical. I do not spend time with people who put me down. So if someone, and this happens to everybody, whether it's your family members or your friends or your colleagues at work, there's always somebody who wants to take you a notch down. And that could be because of their own issues. It could be because of some tension you have with them. Who knows? But I don't ask any questions. I don't argue with anybody, but I remove those people from my life. It's just I'm cutthroat about it. And that has really saved me from a lot of negative situations. And that helps me to be emotionally healthy, to be around people who I love and who inspire me. On the spiritual side, what makes you spiritually unhealthy is to be covered with anxiety or worries or regrets. So I don't say to myself, ugh, that was horrible that I lost this money. I'm actually grateful that I've had the chance to be where I am in life and to learn what I've done. And so replacing worry and anxiety and regrets with gratitude, that's how you be spiritually healthy. I don't mean it in this God or religious way. I just simply mean look at the abundance in your life instead of always focusing on the worry. Again, worry has never solved a single future problem, but it does sap your strength today. And that's an important thing to remember.
So how do you take that worry and translate it into something positive? Because I do hear that myself from a lot of entrepreneurs. They're very worried about things, and being worried is healthy because isn't it like you're getting your attention focused on the right thing?
No, worry will never. People think that worry drives you and focuses you. It doesn't. Of course, being aware of what problems exist in your business will focus you, but being passionate about your business is what focuses you to solve problems, not being worried or scared. So the key thing is to notice, oh, I'm worried. Then to take a step back and say, well, what am I worried about? And then to be grateful, okay, I'm glad I found these problems in my business. Now, because I love my business, I love my product, I love my customers, I'm going to focus on solving these problems. Worry won't solve the problems. Your passion and your focus will.
All right, so now
getting as quickly away from worry as possible is the key to success in your business.
All right, so now let me take you through a hypothetical situation here. An individual runs into $10,000, right? They inherit it, whatever it happens to be. How would you invest that in yourself?
That's a great question, and that's a question you and I have gone back and forth on literally since 1996. I think we first discussed this.
Yep.
The way I would invest in myself is by, first off, I would not put it in the stock market because that's just throwing it into the garbage can. I would invest in time for myself to come up with ideas to improve my business. Cash equals time. Cash equals freedom from some worry. $10,000 might buy you a couple of months. For a young person, might buy you a couple of months of your expenses. So use that time to exercise your idea muscle. Ideas are a muscle that have to be exercised every day, or else your idea muscle atrophies almost instantly. So you need to buy yourself time to kind of develop ideas for other people, for your customers, for your business. That's how I would invest my cash, is invested in my own freedom so that I can come up with ideas, so that I can get healthy, so that I can get energy in order to build products that help customers, that make me money.
So free time is really the goal, to get some free time where your mind is not cluttered with other work so that you can actually come up with a product or a service, if I'm hearing correctly, that would connect with people. And you need a little bit of a breathing room, correct?
Right, like ideas are like anything else. You can't just pick up a violin and be a master violinist. You have to practice. So it's the same thing with business ideas and entrepreneurial ideas. You have to practice coming up with ideas. I have waiter pads all around my house where I write down ideas all day long. Again, I'm not trying to come up with a brilliant idea on every single one. I just need to exercise my idea muscle every single day. And everybody needs to do this, or else, again, it atrophies the same way your leg muscles would atrophy if you didn't walk.
All right, listen, the book sounds like it's amazing. Choose Yourself by James Altucher, with a foreword by Dick Costello, the CEO of the now public Twitter. How did you get Dick to write the foreword, and what does he say in it?
Well, I've known him for a long time, and so I asked him to write it. He agreed, and then some time passed. He did a commencement speech at the University of Michigan, which we talked about, and he took elements from that. I thought that commencement speech was very much in line with a lot of the ideas in my book, and so he took elements from that commencement speech plus what he knew about me, and he wrote a foreword, basically saying, he thinks I'm crazy, but this is what you have to do to be successful. Follow this book.
Well, that's a pretty big endorsement, and amazing that you got such a busy executive to write that. So congratulations on that. Now,
I was very grateful.
Living the dream. If you could sum up what the dream is for any entrepreneur in just a sentence or two, how would you summarize what living the dream actually means?
The dream is freedom. Right now, we live in a world where everybody wants to put you in prison, whether it's schools or family or colleagues or other businesses or institutions or the government. Everybody wants to keep you constricted with their own ideas of how you should live your life. So I want to live my life in my own way. I want my freedom. And so I think for every entrepreneur, they have more or less the same goal. You get there by delivering value to your customers, but the ultimate goal is freedom. It's choosing yourself.
There you have it, folks. James Altucher, the name of the book, Choose Yourself, Be Happy, Make Millions, and Live the Dream, which of course means being completely free to pursue your dreams, keeping those negative people away, staying healthy emotionally, spiritually. And you can get this amazing book over at audible.com. Go ahead and you go to audible.com/twist and you'll get a free audio book. Hey, maybe you'll take James's. And forward your Audible confirmation email to audible@launch.co, and you'll be entered in to a contest to win an iPad mini signed by me, Jason Calacanis. The contest ends December 18th. All rules and regulations apply. Not that we have any. Listen, James, you're always a great guest. I can't wait to listen to the book. I've downloaded it. It's in my Audible. And do you have a favorite book on Audible right now?
I think my own book is my favorite book. I've actually listened to it, and I learn from it each time. I forget what I've written.
That's a little bit weird to listen to yourself on Audible, don't you think, James?
Well, when I was saying earlier, I totally riffed when I read this book. I read basically, news stories. It's a completely unabridged version, so I get a kick out of listening.
There you go. Okay, James Altucher, the most honest essayist and thinker in the technology industry, is so honest that people get disturbed by his writing, as one person told me recently. Just mega honest, and I think that's his brand.
Who is that?
I was talking to somebody and they were talking about like my essays, and they're like, yeah, like you and Altucher, like I always feel like you're like really brutally honest, and then I feel like Altucher is just like on a whole nother level of like, I read it and I'm just like, the next paragraph he might say something that just disturbs me because his life is so effed up. But you
take that as a compliment.
But you do say like you've had some disastrous moments in your life. And you put it out there.
That's true.
And you put it out there. What compels you to put it out there, James? What is it that compels you?
I think there's this myth of perfection. You have to be perfect all the time. And so I basically try to I try to help people by showing them that, nothing's perfect. Life's not perfect. We have problems, and you have to get through them in order to succeed, in order to achieve mastery.
There you go. See, there's James Altucher's big contribution to society, showing people that they don't have to be perfect by showing how effed up he actually is. Fantastic.
That's the only way to show it.
That's the only way to show it. James, listen, you're a great friend. We've known each other for 2 decades. I always enjoy our time together, including this time. Everybody go to audible.com. Thanks again to Audible for letting me do this great interview on Author Extra.